slowly, yeah.
It's a lever the Bank of England's economists have voted to pull yet again. Their latest manoeuvre to get double-digit inflation under control. Interest rates today go up once more, and so the cost of borrowing for everyone.
Before today, our borrowing costs had increased by 88%. This puts it over 100%.
John Spencer's tugs transport cargo across the UK and Europe. Last year, he spent £3 million, much of it borrowed, on new boats. This year, though, his fleet won't get any bigger. I know you bought some boats last year, but then this year you won't be. You won't be expanding.
Absolutely won't be expanding this year. I can't see it. It just isn't feasible. I don't see us investing in the UK at the moment.
So as it stands, you're quite literally taking money out of the UK to invest elsewhere. That's how bad the situation here has got?
Potentially.
Today, the Bank of England's Monetary Policy Committee decided, as expected, to raise its base rate by 0.5%, bringing it to 4%. That's the 10th consecutive rise and a high not seen for 14 years. Businesses that borrow are now having to reach deeper into their pockets. So too, consumers on tracker mortgages, up on average by £49 a month.
Thank you. See you later. Bye-bye.
Gone are the low rates of the last decade, but with lenders expecting today's decision, fixed-rate mortgages, though still on average above 5%, appear to have stabilised.
It's quite encouraging. Obviously, the mortgage rates that are coming in now are fixing sort of slightly lower than they were sort of the end of last year. All the people that I'm speaking to at the moment, all they want is some stability. Personally, I've seen mine increase now by £200 a month, and you know that's as you know. For myself, I've seen the impact then on my income and my bank balance, shall we say.
It's a delicate line to tread, targeting the inflation weighing on household budgets without slowing the economy down when it's in desperate need of a boost. Yesterday, the International Monetary Fund said the UK was the only leading economy likely to contract this year.
Well, there's always a trade-off, and I wouldn't really envy any policymaker at this stage. Bank of England is already forecasting a recession this year. Even though it's a shallow recession, the economy is in a vulnerable position, and raising rates further is just going to make it more vulnerable and weaker.
But amid the doom and gloom, a glimmer of light. The bank hinted the worst may be over, that its latest interest rate could be the peak. Its governor, Andrew Bailey, said there are signs the UK has turned the corner on inflation. And although the bank predicts we'll enter recession this year, they say it'll be shorter and shallower than expected.
Well, our economics editor, reporter Neil MacDonald joins me now. I just promoted you. How sure can we be that we're over the worst, do you think?
I think there's growing confidence at the bank that inflation has peaked, and that could be a big turning point for our economy because, of course, it's high inflation that has squeezed living standards and hurt a lot of businesses. The big question now is how far and how fast inflation is going to fall, and there the bank is being a lot more cautious. So if we look at the central forecast the bank put out today, inflation potentially peaking last October at 11%, and this year falling really quite fast, down below 4% by the end of the year, and it keeps on falling. Now, that is a dramatic change. Of course, this is partly about the way the inflation statistic is calculated. It's an annual figure. Of course, we know there are a lot of price rises last year, gas and food and so on, and as those things drop out of calculation, the annual rate comes down. That doesn't mean to say that anyone's prices have necessarily fallen. So we may be seeing the back of high inflation, but we're not necessarily seeing the end of its impact on people's budgets.
Right, so what could go wrong with this then?
Well, the bank's focus right now is all about the jobs market. The evidence it collects shows wages going up at about 6% a year. Of course, workers have been trying to get higher wages to compensate for the inflation, and companies have been willing to pay those high wages to fill the vacancies they've got. But the bank fears that wages going up at that rate will simply be passed on by companies, if they can, in higher prices, and that would just mean inflation staying higher for longer.
Well, let's talk about the long-term outlook for the economy, because there was quite a lot of info on that today, wasn't there?
Yeah, I mean, this improvement in the short-term outlook was rather overshadowed by the Bank of England telling us that the long-term prospects for economic growth, they think, are actually quite weak. This is looking at how many workers we have in the economy and how productive they are. So it thinks if you went back to the millennium, the sort of potential growth rate of the economy was about 2.7%. By the 2010s, that was down to 1.7%. Its numbers for next year and the year after, just 0.7%. I mean, it halved. It's a pretty dreary set of figures. The problem here, partly Brexit, thinks the bank, because it reckons that means less trade between us and the European Union. Less trade tends to mean slower productivity growth. But there's also a problem in our labour market. After COVID, a lot of people, over 600,000 people, have left the jobs market. Now, that did happen in other countries, but what is different here in the UK is that those people have not returned to the labour market. And today the bank said that they may not return anytime soon, perhaps not at all.
Neil, thanks very much. Well, earlier I spoke to the Governor of the Bank of England, Andrew Bailey, and I asked him how big a risk he thought he and his colleagues were taking by raising rates despite that looming recession.
Well, I think the situation we find ourselves in is that I think that there are now signs that inflation is beginning to turn the corner. But it's very early days, and there's a big risk, there are big risks out there which may throw us off course. And it's really those risks that we spend a lot of time in the Monetary Policy Committee going over, because we have got to see real evidence that inflation is now coming down. I mean, it's unacceptably high. It has been for a while now. We've got to get it back down to our target of 2%. We think there will be quite a substantial fall this year particularly because of the reversal of energy price rises. But it's not a given.
Right. So give people a little bit more of a glimpse of those sunlit uplands that we once used to talk about. I mean, how likely is it that interest rates have now peaked?
Well, I can't give you, I'm afraid, a precise sort of percentage probability on that, and that's because there are very big risks in the economy. What I will say is, and this was very deliberate on our part, that we have changed the language we use this time. So previously we've been saying, if the economy evolves and inflation evolves as we think it will, then there will be more interest rate rises, and we have not said that this time. We've also, in that previous language, we also used the word, and we will respond forcefully as needed. And we've not said that this time. So
things are better but not good enough.
You can see that there is a change there, but we need to see more evidence coming through.
So it's a better than expected picture in the immediate term this year, but a terrible long-term outlook. Your thinking is that the UK economy won't return to pre-pandemic levels until 2026. I mean, the UK used to be called the sick man of Europe in the 60s and the 70s. Are we now the sick man of the world?
Well, what's happened, and what's unusual about the UK, is that in many countries, most developed countries, when COVID hit, there was a fall in participation in the labour force. No great surprise, because obviously countries went into lockdown and so on. What's unusual about the UK is that almost all other developed countries, that's reversed, and it hasn't in the UK. So that the supply side of the UK, the capacity of the economy, has reduced in that sense and has stayed lower. We're not back to where we were pre-COVID. We've got a smaller labour force than we had.
How much is Brexit to blame for the long-term problems we're now looking at in the economy?
Well, we've had, I think, three very big developments in the UK. COVID, the energy crisis, and Brexit are all obviously very big things of recent years. They're all having an impact on the supply side of the economy. It's hard to, in a sense, apportion, contributions at this point in time. But our conclusion at the moment is we've thought really for quite a long time that Brexit would reduce productivity in the economy. We thought it would happen over a rather longer time. The reason it would happen is because the economy is less open. So, as I always say, I'm not taking a view on Brexit per se. I'm merely pointing out there is an economic consequence of a decision to reduce the openness of the economy.
And that might be why we're doing worse than other advanced economies.
What I would say is the evidence we have at the moment is that effect isn't necessarily going to be larger, but it seems to have happened more rapidly.
Do you understand why public sector workers are going out on strike? Do you sympathise with them?
Well, I'm not going to comment on individual wage industrial relations issues in individual parts of the economy. We look at the economy as a whole. We look at wage settlements as a whole, and wage settlements as a whole, although obviously the private sector is a very important part of this, have been higher than we thought they would be in recent times. But we see some evidence of them now starting to come off somewhat. So we're watching that very carefully.
Have you ever gone on strike in your life? Have you ever joined a protest march?
I've not gone on strike in my life, no.
A protest march?
I don't think I've been on a protest march.
Governor, thank you very much.
You're very welcome.